Hey, everybody. Welcome back to Investing Unscripted, where we ask and answer the hard questions about investing. I'm Jason Hall, joined by Jeff Santoro, the voice of the people. Hey, buddy.
I want the listeners to know I just asked you to re-record the opening because you always yell when you first do it. But then I think I ruined your mojo because you were just a little odd that time.
All right, let's do it again. Hey, everybody. Welcome back to Investing.
But you did it again. You yell and then it's over.
Look, I'm binary J. Come on, bro.
All right, whatever. Anyway, I'm great. How are you?
Maybe a little subdued now. I was chastised by my co-founder of our media empire.
It's just because you're very sensitive. When I give you feedback, you like visibly get sad. So
it's just when you give me bad feedback. So, all right. And we actually recorded another show this week. I'm just going to say it's somebody that you and I have massive respect for, who has a book that's probably going to be a bestseller that's coming out. That episode is going to come out in mid-September. But what we decided to do today is something we've done once in the past. And of course, I overpromised that we would do it on a regular basis. And I think once a year is a regular basis. This is almost exactly, this episode will be out literally 1 year to the day from when we did it before. And this is going to be Investing Unscripted.
Yeah, it was an idea we had while we were talking about what to do for this episode. And I pointed out that Jason probably said we were going to do it regularly. And we back and looked and we were like, oh, wow, it was about a year ago. So
literally 1 year ago.
So I'm glad we're going to do this because ever since we started the Patreon $5 a month starter position, we moved the rough cuts, which are, I think, a fun thing that's part of our little media empire here, to behind that paywall. But the vibe of this show, I think, is going to be rough cutty and actually a lot longer than a normal rough cut. We try to keep those to 5 or 10 minutes. But this is truly unscripted. We have absolutely our planner is blank. We have no preconceived notions of what we're going to talk about. And we're going to treat this truly like a rough cut where we just talk about what's going on in the markets, what we're thinking about, stocks we're interested in, thoughts we're having. And I have no idea where this is going to go. So we'll see how it unfolds over the next 45 minutes or so. So let's start here, Jason, because I guess if there's a macroeconomic thing that I hear about a lot and actually am kind of forced to talk about a lot, it's two things. It's interest rates and tariffs, which I think is what everyone's been talking about for the past years. But I feel like interest rates more recently with the recent Fed meeting and Fed comments and questions about Fed independence and will we get a cut in September and will we get any after that and all those kinds of things. And the funny thing is, as we went back and looked at this episode we did about a year ago, or exactly a year ago.
You know what we talked about?
Interest rates.
Exactly. Yeah.
So it is the theme that never goes away. But I'm curious, you and I have talked about this kind of stuff a lot publicly, but not together. So I actually don't know what your thoughts are as you look at the big macro, so to speak.
Yeah. So again, this is part of when I talk about interest rates, I bring this part up a lot, is that usually when rates are moving up or down, there's a reason. And often that reason is not a good thing, right? What's good is when Fed's monetary policy doesn't need to change, because that means everything in the economy that the Fed is looking at, inflation, employment, those things are steady and they're trending in the direction that the Fed wants to see. Because again, the Fed's there are two things that they do are managing inflation, again, with that goal of around 2% average inflation, and looking at jobs, keeping the unemployment rate low, keeping the percentage of the population, the working age population that wants to work and is able to work, working. And interest rates is by far their most useful tool, the one that we hear about the most. So, I mean, we could talk about quantitative easing and using the Fed's balance sheet to buy and to hold assets to make it easier for lending markets to function and for the money to flow. We don't even need to bring that one up. So interest rates, again, that's the big one we hear about a lot. So I think the thing that we kind of lose the thread of sometimes is when the Fed's talking about cutting rates, and we've seen this, Jay Powell's been adamant about this, is that the Fed lowering rates would need to be for a reason that serves the economy, not that serves President Trump's agenda.
For the stock market.
which is part of President Trump's
Yeah,
agenda,
yeah,
right?
yeah.
And from our purview, right? So that's something we definitely see. And I think that it's really interesting, Powell's comments, because there's really kind of become two different schools of thought on it. There's the school of thought that is, hey, this is just keeping a pretty good economy strong, right? It's kind of that nuanced, maybe like a 25 basis point cut in September, maybe another 25 basis points before the end of the year. So not the big half percentage point, the 50 basis points that we usually see the Fed do when it makes a move. That's just kind of like the bigger move. So it's a little more just kind of a little nudge. And there's a big school of thought that it's like, hey, there are some parts of the job market and the economy that are a little soft. This might help boost investment, right? Might help companies plan with a little bit better cost of capital that could encourage maybe a little more hiring in some of those areas, make it easier for companies that want to deploy capital that are going to be taking on debt to do it, encourage investors to put their money to work in capital versus debt, right? So if interest rates are coming down, so like all of those kind of things. And then there's the other school of thought that it's like, well, it's never good when the Fed's cutting rates because there is softness in the economy and weakness, right? And so that's like the other side of the coin there. So how am I thinking about it? I'm not, right? It's just a thing that's going on. And it doesn't directly, like, I'm not a big bond trader. I'm not like looking at a lot of those sorts of things to try to like squeeze out a little bit of better return in some way. So it's not really changed anything for me. What about you?
It's funny. Like I listen to a lot of investing and business podcasts and read a lot of newsletters. So I always have a hard time distinguishing what is my thought versus something I heard or read. But
yeah, well, it's human nature, right? We rarely form our own opinions. We usually just find one that we like and we try it on and wear it for a while.
Well, here's what I'll say. What I do think is unique to my thinking is I have thought for ever since really we started this whole tariff stuff and also the immigration stuff. It just seems to me that at some point we're going to have to see the economic impact of deporting inexpensive labor and putting a 15 to 20% tax on consumers, which is what the tariffs are. And I've been saying that for months now, and I've been wrong so far. But that was always my gut feeling. And I even before that, I remember saying out loud on this podcast and in other places, public, the market doesn't like uncertainty. And if you say what you want about all the policy changes and things that are going on, but it is introducing a lot of uncertainty into the market. So just from that standpoint, I thought the stock market would struggle. And
it's just shrugging it off.
Right. So one of the things I wonder / think based on what I've heard and read again is my sense is that the Fed, and we always say Powell, but we have to remember it's a vote of a bunch of people. It's not just his individual decision, is probably thinking the same thing, right? Like they're probably looking at the environment and looking at the data and listening to what the people who are actually our economists are saying and thinking at some point this has to start impacting the economy. And from that standpoint, you can understand why they were hesitant to raise rates at all the other quarterly meetings when they make the rate decision. And here we are now approaching another one. It does seem like, based on the commentary from Powell at Jackson Hole, but also just what the market's pricing in, that we will get a cut in September. But also there's a lot of data still to come between now and then, so who knows? But I really think that they're probably thinking to themselves like, I don't really know if this is the good idea, but maybe a 25 basis point rate cut in September is enough to satisfy the president and the markets. And then maybe that's all we get, or maybe it goes back up at some point. Like that's the thing that I just wonder if they're hesitant because of the whole, like, okay, it hasn't happened yet, but we think it's going to in terms of like a downturn. The other thing I wonder is I feel like a lot of investors, a lot of people who follow the markets, maybe casually, think that like an interest rate cut is a panacea. And all of a sudden stocks will soar another 20% and everything will, I mean, and I know like 25 basis points can be a lot to like a bank that has billions of dollars that they're trying to gain interest on, but it's not like this is going to make mortgage rates drop back down to 3%.
Yeah. And this doesn't change the affordability crisis writ large.
Yeah. I mean, look, if I was borrowing money and I could get it for 25 basis points less, I would, but that's great. But it's not like it's a 2% decrease or something like that.
Right.
So I'm a little bit like, okay, so we'll get one in September, and then I feel like everything's going to be exactly the same. The last thing I'll say is I really am just fascinated in watching very closely all the political stuff, right? What happens when and if the world loses its confidence in our financial system's ability to call it straight, so to speak. And what I wonder is, the thing that seemed to shake Trump out of what he wanted to do was when bonds started to go the wrong way in April. Like that, for all the reporting I read seemed to indicate that was the thing that.
Yeah, no, there was a bond auction that was on the cusp of essentially leaving the federal government unable to fund itself.
And I just wonder if what will be, or if there will be, a economic indicator that hits the brake on some of the less great stuff going on.
Mm-hmm.
But to look at it as an investor, I think I'm trying to keep buying and not time the market, because obviously if I had stopped buying stocks back when I first thought the economy was going to go in the other direction, I'd be a lot poorer right now.
Or sold, even worse, right? Yeah.
Yeah. But I'd be lying if I didn't say every single time I go to buy a stock, I think to myself, like, there's a chance this stock will be 20% lower in a month.
Yeah. But there's always that chance.
I know,
right?
I know.
Thing. I want to pull on that thread a little bit, but first I think thinking about interest rates in the businesses that I own, I do think about that a little bit, right? I mean, it's not like a major catalyst for buying or selling stocks, but I've been very bullish on Homebuilders for years. And largely that thesis has worked out extremely, extremely well, particularly with like the smaller home builders that are in the really good markets that have been ahead of the trends. Like the big trend, we talk about affordability right now. For years, the builders were just building like big custom homes, like 2,500 square foot and larger custom homes, not entry-level homes, not like condos and townhomes and smaller starter communities. Like we spent basically a decade not building those. And a few builders, smaller builders, really got into that really 6 or 7 years ago, started shifting more of their land buying focus and their building focus to that sort of thing. And that trend has worked out incredibly well. And I think like when we talk about the affordability crisis, there's two different parts of it. One is the large segment of our population that lives paycheck to paycheck, right? Where rents are unaffordable. The part of the population that's not really going to be in the market for buying a home anyway, where it is truly so burdensome that they're having to make hard decisions about what food they can buy because the rent is so, and that's one thing. And then there's the affordability for people that have saved money and they have very good incomes. They're at the median income levels, and they want to own a home and they're being priced out. And one of those is a crisis, and one of those is a first world problem, right? If we're being honest. So I want to talk about that. So as an investor, the first world problem is the one where I see opportunity. As just a person in the world, trying to do good in the world, the crisis is the crisis. And those are two, they overlap because they're around housing. But as an investor, Meritage Homes, Green Brick Homes, those companies, they're not going to fix the affordability crisis. That's the crisis, right? That's actually harming people, that's hurting their ability to have a good quality life. But they are addressing the affordability that's a lot tied to just a mismatched kind of inventory that's available by building smaller and starter homes in entry level and first move up communities and things like that in the Sun Belt and areas where costs are lower, where the trends are favorable in terms of migration, right? So interest rates matter for those businesses on both sides of the balance sheet. I talked about this on the Motley Fools podcast a couple of days ago. By the time this airs, it'll be a week or so. But companies like Homebuilders, interest rates are really important to their buyers, right? Because they're going to mortgage the house.
Yeah.
Most home builders also finance a lot of the land that they buy. So interest rates are important on their balance sheet too, right? So those are businesses where a 25 basis point cut helps them in multiple ways that I think are really, really important, right? So I think it's important as analysts of businesses that we're interested in buying. The macro is the macro, right? But understanding how those things impact the financials of the businesses that we own is far more important than thinking about what is it going to do to the economy next quarter. So I think that's just an important thing that I wanted to talk about. What I wanted to ask you though is thinking about all of those things, and the good segue from that is you were talking about every time that money's in the account and it's time to make a decision about buying, the actions that you choose to take in your portfolio. What over the past year, last month, this year, however you want to think about it, how has your investing process been impacted by all of the noise around interest rates and the macro?
I'm less excited / impatient / immediate go to the account and buy. That's the big thing I noticed.
FOMO Jeff has had water poured over him.
Yeah. And I know that like when we hit, because I know this about myself, like if we're like in April when we had the market drop like almost 20% in like a week, I was like, where's my money? Let me go buy something. And actually didn't even buy that much because but like that was my instinct. I think here's what my rational brain is saying. And I actually got some confirmation bias when I read, there was a Howard Marks memo last week or two.
So Howard Marks is the founder of Oak Tree Capital, which is a big distressed debt lender, part of Brookfield.
And he was writing about basically, I didn't think we were in a bubble last time I wrote, although I saw some troubling things. And now I think maybe we are in a bubble. That was basically the gist of it. But he listed like 6 things that you could do in a time like this. And he made a reference to like the DEFCON levels that the US government uses for nuclear war. And you know, it was like the 6th one, I forget what the 6th one was, but I think the 5th one was like basically buy safer stuff and don't buy your super aggressive stuff right now. And that's actually where my brain was before I even read that. Like the things I have bought have been more companies I have conviction in that I think are still a compelling valuation, but I kind of want to just buy the stuff that has crushed into my portfolio, right? Like there's some stuff that's just been doing really, really well. And I like the idea of adding to my winners. But the thing I keep coming back to is like, is now the time to be smart about where I put my money in terms of valuation? And then like when we're in either a downturn or a quote unquote normal market where like maybe things are up, but not bubbly and frothy, is that the time to buy the small cap that's up 100% in the last 6 months? And just kind of think, not stop buying, not go to cash, not sell things, but just be more discerning where I put my money in a time like this versus a time when the market is a little less exuberant. But then there's always the other side of that argument, which is what if this exuberance lasts 3 more years? You know, I think Ben Carlson wrote a post on his blog the last couple of days. Are we in 1996 or are we in 1999? Making the point that at both times the market looked kind of like today, if not worse. And if you had thought it was at the end of it in 96, you lost 3 years of growth. But if you thought we were in the middle of something great in 99, you were about to get crushed.
Yeah.
And
crushed in a way that could fundamentally alter your financial trajectory for the rest of your life.
Right. Yeah. All right, folks, if you're a regular listener to Investing Unscripted, then you know that we use Fiscal.ai, formerly known as FinChat, daily. Fiscal.ai is our complete stock research terminal. It's where we have our investment dashboards. It's where we create financial charts. It's where we read all the transcripts for the conference calls, sell-side events, shareholder meetings, and it has Morningstar's high-quality research reports on more than 1,700 companies. It really is the complete research platform for stock-focused investors. If you use our link, fiscal.ai/unscripted, you will get an automatic 2 weeks of Fiscal Pro for free. And if you find that it's worth upgrading, you will get 15% off any paid plan with that link. Again, that's fiscal.ai/unscripted. The link will be in the show notes.
Hey listeners, my name is Brett Schaefer, one of the hosts of the Chit Chat Stocks podcast. On our show, we do comprehensive stock research reports, interview analysts, and learn from great investors. And we have coverage on stocks like Airbnb, Nubank, Mercado Libre, and many others. Plus, we cover all the hot financial news on our weekly investing power hours. We have episodes for all types of investors and think if you listen to this podcast, you will enjoy ours as well. Follow the Chit Chat Stocks podcast on YouTube, Spotify, or Apple Podcasts and start discovering new investments today.
All right, I want to pivot and talk about something slightly different because this is another like big thought I've been having the last couple of weeks. There seems to be a universal consensus that AI is a transformative technology, second only to, or maybe even more transformative than the internet, that will alter life as we know it. And anytime something is that much of a consensus, I start to wonder if it's maybe completely wrong.
Yeah. Well, again, getting back to Ben Carlson's post, right? 96 or 99, one of the biggest bubbles most of us have invested through was about the top. Yeah.
Yeah. But what if, here's the other thing, who's out there the loudest about how transformative AI is going to be? OpenAI, Google, Microsoft, Meta, and pick the
companies that make money building and selling AI.
Now, I've used AI enough and know enough about it to know that it's pretty cool, but I've also used it enough to know that it doesn't quite do all the stuff I want it to do yet. And I'll give a quick example. And I get that this is anecdotal, and I get that it'll be a better in a year from now and a better a year after that. But like, I'm trying to get ChatGPT, when I give it a list of 500 stock tickers, I'm trying to get it to give me a list of when they're all going to report earnings, but only using, like, it misses stuff. And then I say, like, well, what about Apple or whatever the company is? And it'll be like, oh, you're right, I missed that. There was a post on their investor website that is reporting tomorrow. And I get that that's a complex thing, right? It has to search hundreds and hundreds and hundreds of websites specifically and click around and all that stuff. But I don't know. And I get that maybe 5 years from now, that'll be like the easiest task in the world. But when I think about how much it's being hyped and by who, when I think about the incredible amount of data centers and energy, electricity we're going to have to build and generate to make this work at scale. And when I think about the fact that, like, ChatGPT 5 just came out and it's hot trash, what if it's just not going to come anywhere near our expectations? What if it really is just going to be a parlor trick for consumers and a neat thing that we play with? And it helps with some stuff. Oh, here's the ingredients in my fridge. What can I make? Great. Perfect for that. I'm planning a trip to San Francisco. What should I do? Perfect for that. Maybe businesses find ways to help it become more efficient. But everyone seems to think it's going to be massively disruptive, take jobs, lead us to a utopia or a hellscape. And I just wonder if it's going to be something like the smartphone, right? Like, it was a big, huge thing that we all use, but it didn't, like, I don't know, it didn't change the world. I guess it kind of changed the world, but like,
I was going to say, I'm going to push back a little bit there. So I think first of all, I think you're selling AI today a little short. And I know you were being glib using the term parlor trick, but I think AI already has had a bigger impact maybe than you realize. I think in the corporate.
All right, hold on. I want to hear the rest of your thought. All right. Yep. I'll concede that point to you, but I guess what I'm trying to say is, what if today's level of disruption is as far as it goes?
So I don't think that's going to happen, but I think where we agree is there's going to, again, it's the hype cycle, right? And we can look at the internet and the hype cycle of the internet, the peak of inflated expectations. I remember exactly what it's called. That was the late 90s, right? And then the trough of disillusionment was pretty much, if we really think about like the technology and like its impact on people's lives, it was really until 2010. And I think part of the thing that started leading to the change where we climb out of that trough of disillusionment was smartphones. Because I think smartphones probably fundamentally changed the way we use the internet in ways that we don't think about, right? Because it decoupled us from a computer that was plugged into the internet. And we put all of that access to data in our pockets, right? And as the technology got faster and more powerful, steadily unlocked more and more and more things, right? So I think taking that same idea and thinking about it with artificial intelligence, because I think number one, the internet was doing a lot more things than the average person saw back in the 90s and through the 2000s. We weren't as consumers necessarily engaged with it as much until we were totally plugged into it.
Yeah.
And so I think that with AI, it's going to be the same thing. We're going to go through this period where it's going to feel like, okay, where's all this awesome stuff with AI? And then maybe 10 years from now, it's going to be so embedded in our lives that we don't even realize it. And I think it's the key part of it is that it's when it's the stuff in between us and the technology the integration of AI into things that are going to look and feel and kind of operate a lot the same way that they do now, that make it, in other words, we don't have to change the way we do things in massive ways to start being able to leverage artificial intelligence in ways that make things better.
I hear you. I think and I'm not naive to think it's not going to be better 5 years from now. Like I do believe that, but I guess my point is, like, when you talk about the hype cycle, right? Yes, there's the exuberant part, there's the trough of disillusionment, and then it kind of comes back over time slowly to be this transformative thing. I guess my wondering,
and the key about and a lot of people, like as investors, we look at the hype cycle and we think we're looking at stock prices, and it's not stock prices, right? That's not what the hype cycle is saying. Is like, when I say like the peak was in the 90s, we automatically correlate that to the stock market peak. And then the trough of disillusionment was the market crash. And yeah, they align, but the hype cycle isn't actually showing the value of assets. It's showing how
I get it. What I'm saying is,
I'm saying that for our listeners as much as for you.
Okay. But what I'm wondering is, after we pass the peak and hit the trough, what if it just never comes back to the level people are predicting? That's sort of what I'm thinking. I don't even know if I believe this, but there is part of me that thinks, again, it's such a consensus that this is going to be a game changer. And there's every scenario that I could understand, the scenario that you just laid out, where like, that's what everyone thinks now. And then maybe 3 years from now, we're all like, AI is nothing. And then it turns out to be awesome. But I'm wondering if it just turns out not to be like good. We use it, it's there, but not this. I mean, people are acting like, in 20 years, no one's going to have to work.
Yeah, right? Those people are idiots.
And there's going to be a universal basic income. And we all just sip Mai Tais by the pool for the rest of our lives. Like, I know that that's like the most extreme.
Right.
But here's the other thing I think about, and I want to be careful how I say this, because I was not paying nearly as close attention to markets and business in the 99, 2000 time as I am now, right? I was in college. But I think the big difference is, yes, there were hundreds of companies that popped up and put .com at the end of their name and tried to ride that internet roller coaster. I think the difference between then and now is we have these 5 to 10 just insanely huge, profitable, cash generating companies that can just incinerate money for years. And if it doesn't work out, they will be fine. And they're the ones pumping money and promoting this. That was not the case in 99 and 2000. Yes, there were big businesses for the time, and they were certainly spending on the internet. But I don't think, even if you compare size, percentages, I don't think it was anything like what we're seeing now.
No, I think you're right. And I think the key part of that is like, if you think about the markets now versus the market then, the companies that were the biggest failures, the ones that truly went to zero, they weren't talking financial results on their earnings calls. They were talking about website traffic. Mm-hmm. And those were the metrics they were reporting to underpin like their growth as businesses. And sure, there's plenty of businesses out there talking about how they're integrating AI, and like it's a story, right? But yeah, the key here is exactly what you said. The businesses that are kind of leading the charge here, that are spending the money, they have the money to spend, and they're talking financial metrics, right? And to me, that's a big difference. But with that said, if you look at the valuations of these businesses that are in that ecosystem, they are inflated. They are expensive, because there is a lot of expectation priced into those businesses that AI is going to be something that is going to generate cash flow, right? Not just CapEx and operating expense. At some point, it's going to be something that they're making a lot of money from. Because right now, you've got NVIDIA, ASML, and TSMC, right? Those are the three companies that are making money, and ASML not as much, honestly. It's really TSMC and NVIDIA. Those are the two companies that are making the most money today directly from the investments into artificial intelligence, because they're selling the picks and shovels. We're starting to see more of like this is one I use a lot, Salesforce is a good example of a company that's saying, here's how we're integrating AI and here's how we're selling AI. Microsoft is another one too, because they have it pretty integrated. I think you probably use it a little bit through some of the Microsoft products you deal with. And a lot more people are, though.
I don't use any Microsoft products, to be honest with you. I'm entirely in the Google ecosystem.
I guess a lot of educations move that way. But again, that's the key is we're starting to see those are the businesses that are really integrating AI in ways that more enterprise users and schools are kind of enterprise users as well, right? In terms of how they integrate with software. I think those are the businesses that are going to be successful making money from AI. And their most important thing that they can do is integrating it in ways that don't add steps or make things harder for their users. They need to clearly make things easier for their users. And that's why my thesis is that AI is going to be something that is going to be hugely successful and most of us don't see. But my point back to those big businesses, with few exceptions, and Salesforce is actually one of those, with few exceptions, most of the companies that are expected to be big winners because of AI, if we do go through a trough of disillusionment period, their stock prices are going to come down. Those valuations are going to come down because the expectations are going to get washed out.
Yeah. And I don't even know how much, like I said earlier, I don't know how much I truly believe that AI will become a much bigger thing than people are predicting. Then there's other parts of it too that I just question. Like, I don't know how we're possibly going to generate enough electricity for this to like really scale. Yeah. Especially when our current government is against some of the cheaper, most effective ways to generate energy, like wind and solar. But we don't have the world's best electrical grid before this. When do we get to a point where people are living through rolling blackouts so that Meta can power its data center? Like, I just think this could end badly before it really has a chance to scale. And also, this is a little bit doom and gloom, but like, I do worry / wonder about how much we're just setting ourselves up for some sort of attack or disaster, taking down like the entire AI infrastructure of the nation. I don't know. I've just really been wondering, like, and maybe it is just the peak of disillusion or the peak of exuberance, whatever the stupid hype cycle top is called. And that's how I feel this way right now. But it is something I do wonder about. And here's the other thing too, like, let's use Microsoft as the example, since you just mentioned Copilot. Like, when you think about the amount they're spending to build out AI, if it for them ends up just being Copilot built into their products, how much more can they really charge to have those features be paid for by its customers? Like, how much pricing power does that carry? And does it come anywhere close to paying for the CapEx to get there? I guess like over a long enough timeline, I guess it will. But that's what I mean about, and you pointed it out in valuations, but I just wonder, like, on the management side of these businesses, like if they are AI believers and Kool-Aid drinkers, to use a extreme metaphor, then what if the payout is just nowhere near the investment, right? What if the ROIC on all this is just really crap?
That's the big unknown.
Yeah.
That is whenever there's a disruptive technology, that's always the big unknown. So I want to give kind of my answer a little bit to this whole idea of investing in a market that's basically back at all-time highs, that we see the uncertainty with the economy, the whole interest rate thing in the context of this is an economic response, not a Wall Street response from the Fed, the valuation concerns of really the 15 biggest companies, because we got to throw Berkshire in there too, because so much of its equity value is tied to both investors looking at it as a safe harbor, but also it still has a big exposure to Apple and some other stocks that are frankly expensive based on the performance of the business.
Well, every quarter it has a less and less exposure to Apple.
And that's a little telling, I think. But my point is like thinking about my process in these sorts of environments, there's a couple things that I have to come back to. Number one, where you are on your financial continuum is so important, right? Because it's interesting, like contrasting you and me.
I'm so much older and closer to retirement.
So much older, right? But no, I'm closer to retirement than you are.
By like 18 months, but that's okay.
No, it's not much, right? It's just a few years, but also I have so much more money than you too. So I'm closer to early retirement than you. But the other part of it too is you're right on the door of the finish line for, saving for your kids' education, right? At least one of them. Your other child's a little bit younger. And me, I've still got a decade here, roughly, before my kid is done with high school. My point is that it's always about making the right decisions and building the right frameworks for when those goals are, to put you in the best position to it's two things, like put you in the best position to reach those goals, but also reduce the risks of coming up short, I think is a big one. So for me, for my son, still having a decade to invest, there's a little more potential to be willing to kind of take a little bit more risk. But the biggest thing that we want to think about avoiding when my family has conversations around our progress towards those goals is reducing volatility risk too much and overweighting safety, because overweighting safety, you can underweight gains, right? And fall short because you were too busy focusing on minimizing near-term risk. So with this 529, that's pretty automatic. And there's a percentage that goes into bonds and percentage that goes into stocks. And then we have a Coverdell and we have another small cash account for him that we manage that's 100% stocks. And the Coverdell is 100% stocks. One of the things we've done there is I have started prioritizing a little bit more of dividend growth. And that's part of the way that I achieve like the dual goals of generating yield, reducing volatility, but also getting some capital appreciation and the dividend growth part too of those businesses versus, investing in bonds in an environment where interest rates are starting to fall, being mindful around those long-term goals. And then we've done entire episodes about my process and how it's changed in my entire framework around being closer to my big picture financial goals around, retirement and that kind of thing. And what I found is that I've just become a little more selective really around when I'm buying stocks. And I've certainly leaned in a lot more to using options strategies as a way to generate return and be able to leverage a little bit of that larger cash position that I now have. Things like selling puts, right? Where the cash gets tied to the put, but I'm still earning the yield on that cash in the money market because it's still in my account. I can't buy anything with it.
Right. It's allocated.
Yeah, it's allocated. And then the put, the idea is to put myself in a position where maybe stocks that I don't like the valuation now, but I can sell a put at a price that I would be fine to buy the stock for. And the worst case scenario is the stock falls below that and I buy it, I put the stock at the higher price, but that price is still a lot lower than today's market value for that business, right? So I can hedge risk, generate income. And if the stock never falls below that put price, I earn the premium on the put plus the income on the cash. So it's a way that I can still achieve what are acceptable rates of return because I know how much wealth we want to have to reach our financial goals. Yeah. I know what those numbers are, I know what we want to have, I know what we need to have. So it's a strategy that I've started to use more that can give me a little bit of predictable return. But we're talking about, I don't know, Jeff, 5% of my portfolio, the entire invested wealth that I'm doing this with. So it's not something that's creating this massive pool of risk that could just blow everything up. And the rest of it is stocks I've owned for a long time that I have absolutely no incentive to own less of or to not own at all.
Yeah. And I think for me, because I'm so heavily weighted towards index funds, ETFs, mutual funds, things like that, I actually probably should ignore the macro even more in my stock portfolio. And this is a quick little tease for anyone who has not yet joined the Patreon starter position, $5 a month subscription tier. I'm not going to go too deep into it, Jason, because it's more fun when you have no idea, but I want to talk a little bit more about this in detail on our next Rough Cut exclusive that'll be behind that paywall. But I've been thinking more about, and this goes back to what I said earlier, the decision of like when to be more risk on, like is now the time to be a little bit more valuation sensitive because of the way the market is. I'm actually leaning more towards ignoring valuation more and taking on more risk in that sense, like that type of risk, because my stock portfolio is 13% of my invested wealth and not 70% of my invested wealth. Mm-hmm. So that's one thing that I've been thinking more about. And the other thing, because yes, we're both within, we can see the light, the retirement light at the end of the tunnel, I think at this point, but I'm in a scenario where between the fact that I'll have a pension, I know that's different between you and I, and the fact that so much of my money is right now in funds, that I feel like I can play with stocks a little longer, a little further on in my life, because if my stock portfolio goes down by 50%, even the year I want to retire, it's not going to delay my retirement plans as long as I
Right.
have the other 75% or 80% of my portfolio allocated correctly for where I am in my life, right? If that's has a good mix of bonds and things like that, so that I have that level of safety, so to speak, as I approach retirement. And that's unique to me, and your situation's unique to you. So everyone has to kind of figure that out for themselves. All right, let's wrap this thing up. Any other closing thoughts here as we wrap up our completely unscripted conversation?
Yeah, I'm still a better investor than you.
All right, well, that's a perfect way to end it. I will go through our housekeeping here really quick because I haven't done it consistently on the last couple episodes. So quickly, if you're listening to this, if you enjoyed this, if you are a regular listener, or if you just found the show, if you could give us a 5-star rating on the podcast apps and a review on Apple Podcasts, that would be really helpful. Other than actually sending an episode to a friend, that's the best thing you can do to support us and help other people find the show. You can find more content from us on YouTube, on our newsletter, and our Patreon, and the links for all those things are in the show notes. And lastly, check out our Savvy Trader portfolio. We make one stock pick a month. It's always a stock that Jason or I own. That portfolio is beating the market, has been for a while. It's over a year into that adventure now at this point. So if you go to savvytrader.com and search up Investing Unscripted, you'll find our portfolio. And if you'd like to subscribe, you'll get videos with our thoughts on our picks, and you can see what we're doing in real time.
All right, Jeff, let's wrap it up, shall we?
Yes.
So good. All right, everybody. As always, we love giving our answers to these hard questions, even in rambling, unscripted fashion, at least once a year, sometime in early September. Well, 2 years in a row anyway. But as always, remember, it is up to you. It's up to you to find your answers to these hard investing questions. You can do it. Trust me, if Jeff can, you can too. Oh, hey, Jeff. I'll see you next time.
See you next time.